Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Advanced Charting Techniques. And we are sitting right in the middle of a brutal market. Yeah, the S&P 500 is down 16% from its February 19th high. So I have kind of a weird question for everybody watching. Is risk higher right now than it was on February 19th, or is it possible that it may have actually gone lower? Yeah, for some traders, they see a strong move to the upside as introducing risk to the bulls. They see a strong move to the downside as reducing risk. So today, we're going to be talking about measuring extremes using a series of available tools on the Thinkorswim platform to see, have we reached a downside extreme, and could there be, I don't know, maybe potential opportunity for the bulls out there? So should be an interesting discussion. Looking forward to it. Before we can get to any of that, though, let me first of all say hello to everybody who's already chatting in. Great to see everybody. A lot of familiar names out there on YouTube. Hello there, Will and Jay Richardson, Ocean Life, Selva, Ricardo, Chris B, John, Mary, Marcus, Desert Saguaro, and everybody else. Thanks for joining us week after week. We always do appreciate your attendance and your contributions to these discussions. If you're joining us here on this Friday for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, enjoy the presentation, but be aware that you're invited to join us in these live Friday webcast series discussions. These kick off promptly at 1 Eastern time if you'd like to join us. It'd be fabulous to have you here. Now, I also want to let everybody know, speaking of fabulous, we have Ben Watson hanging out in the chats with us. Ben is a longtime peer and friend of mine. We've been working now together, Ben, as of May 9th. I'm finally going to hit my 20th anniversary of working with Ben. So yeah, Ben and I have been working together for a long time. Ben has a wealth of knowledge that he brings to this discussion, and he's going to be answering any questions that I can't get to just during the natural flow of the presentation, as long as they're not too far off track. Ben's there to pick up the slack for me, so thanks for being there, Ben. And Ben and I would also like to issue an invitation to everybody. If you have an account with X, give us a follow there. Follow your favorite presenters on X. It's the best place to connect with them in between the live streams. You can find Ben there at Ben Watson CS. You can find me on X at Cameron May CS. So let's get into this interesting discussion we're going to have today. But as we do that, of course, we first of all need to consider the risks associated with trading. Yeah, risk is real. We're seeing that right now. But just bear these important disclosures in mind. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. All investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. Okay, so with all that said, let's set the agenda for the day. We need to pry our hands away from our eyes and take a look at our existing positions in our paper money portfolio. And as a spoiler alert, it's not that bad. Actually, I was a little bit surprised to look at it today. But we're going to have a look at existing positions, one of which just concluded before this webcast launched. Then we're going to keep our eyes open and look at what's going on with the markets. And I want to look at the markets and individual stocks through a few technical lenses. The focus of our discussion today is going to be using tools on Thinkorswim to maybe measure extreme moves. Since we have a lot of those out there today, I want to talk about 3 different approaches to measuring extreme moves using stock charting tools. So we're going to work through that on the markets and then look at an individual stock, and we're going to plan and place a trade today. So let's go right to it. Crash says, hi, Cam. Let me read through this just a second here. Okay. Yeah, I can't, that's a little bit off topic for me. I don't know if Ben will have some comments for you there, Crash, but I'll let him address that. But let's go to the Thinkorswim desktop. This is the trading software platform. This can be downloaded free of charge from within your Schwab Online account. But here are our 4 positions, or here were our 4 positions. Actually, one of those just went to zero just a few minutes before launch here, but we'll talk about that. First of all, we have AbbVie, and for each one of these, we use a different set of technical tools to plan the trades here. Now, in this webcast series, I like to cover a big range of tools because there are a lot of tools available on Thinkorswim. So we use different ones to plan different trades, and we learn from those as we go along. We develop new skills. That's the objective there. So with AbbVie, we own 25 shares. We tend to keep the investment in individual securities here in this example portfolio under about 5,000 bucks. And you can see bought at 202 down to 191. That's a dip, actually not so bad relative to what the rest of the markets are encountering. But here was where we entered our trade. And here was the logic of that trade. Let's go to our studies and load up a study set. And specifically, we used a ribbon study for the planning of this trade. What we noted here with the ribbon study is that RS1, ribbon study number 1, crossed up and above RS2. Those are our two fastest ribbons in this ribbon study. There are two fastest averages in this ribbon study. But as that RS1 crossed over RS2, we took that as an entry. And even despite this big pullback on ABBV, the plan here is to maintain that position until, ultimately, it's going to happen someday, unless something really weird happens, RS1 crosses back down over RS2. That will be our planned exit. So we're maintaining this position. We had some profit built in, unrealized. Now we've surrendered that, and we're back down into a loss territory. But that's one of the things that can happen when we ride out ebbs and flows on a chart. Using a technique like that one I just described, that's not uncommon. Now here's AON. AON, we have a quantity now of 0. Here's what just happened. Let's bring that up on our chart. Let's bring up our study set for this trade. We used Bollinger Bands for the planning and placing of this trade. What we had noticed with AON is it had recently gone up to, interestingly, an extreme, was hovering against the upper band envelope and pulled back down through our moving average, got down to the lower band, and we got a white candle closing up off of that band, actually a couple of those, so we took our entry right there. Placed a stop just below this lower band. So our stop was just down here. It's not showing on our chart anymore because it's now been executed. But the plan here was to sell if we could get price to rally up to that upper band again. This is going to go in the near miss category. Got really close, didn't quite get there. Had we penetrated that upper band at any point and we saw that in the webcast, we would have taken the profits at that point, didn't get there. And we faded with this sell-off. Yeah, it's pretty good fade here. Not quite proportionate to what we're seeing on the markets again. So getting stopped out here, we took a relatively small loss. All right. So moving on to Netflix. Netflix, more expensive stock, bought fewer shares to keep us under our $5,000 limit. But with our next Netflix trade, let's load up our study set again. And by the way, as I do this, let's load up that Netflix study set. With this, we use our trend value momentum strategy set, which we'll be revisiting again as we look at the S&P 500. But before we go back and look at the details of this trade, I want to point out, if you weren't here for these discussions, for when we took the original positions and we learned those other technical techniques, make sure you do this. Do yourself a favor, and first of all, go down and click on the subscribe button. Subscribe yourself to our YouTube channel. It doesn't cost anything. It literally only takes a second. You'll see a subscribe button right down below the video stream. But our YouTube channel is where we house all of our previous webcasts. Now, there are just a few where we don't post them to the YouTube channel, but the vast majority of our webcasts are posted to the YouTube channel. And you can find that, the name that you'll be looking for, track down Trader Talk's Schwab Coaching webcast. If you go to that homepage on YouTube, you can find the playlist for previous webcasts right here. And let me go to the playlist for this webcast series. So if I click on playlist here, I'm going to scroll down. So this one, again, is called Advanced Charting Techniques. So we're going to scroll down about to the middle. There's our Advanced Charting Techniques. I can click on View Full Playlist right there. And as you read through these titles, you're going to see, oh, hey, there was a discussion of trading with Bollinger Bands. Hey, down a little bit further, the one that we are going to use a couple of times is our trend value momentum. Where do we go? There it is, trend value momentum. Yes, you can go back and watch the logic of these trades as they were initially constructed. But let's go back here and look at what's going on with Netflix, and it's getting fairly close. So with this trade, what we saw here, we're using a combination of two moving averages. These are triangular moving averages, a faster one and a slower one. And as long as the faster one was above the slower one, the green above the red in this case, the technician might see that as still an intact upward trend. Now, within that upward trend, the trader might be looking for signals that the stock is making short-term bottoms. And one of those is our RSI. You can see here we dipped down below the 40 level, and our RSI started to rise out of that just as we were getting this white candle. And a second oscillator here is our MACD histogram. All right, MACD histogram had dipped deeply into red territory and had transitioned from bright red to dark red. Now, this brings me actually, let me do this. Okay, I'm going to go right back to that in just a second because I just noticed something interesting that just happened in the chat right now for the live audience. There's been a survey link that's been added to the chat window for those that are watching live. So if you do me a favor, if you're here with the live crowd, go ahead and click on that survey link right now, and that'll have the survey ready for you to fill out after the webcast is over when you can give me some honest feedback. But I just want to make you a quick promise. Actually, also a heads up. Number one is that it's a very short survey. 2 multiple choice questions, a comments box, and a suggestion box. So fill it out. What I'll say is it's not going to be a wasted effort if you do that. I read through that data and I read through your comments, and it always helps. So it's not like you're filling out some random survey for a giant corporation. No, you're filling out for a specific guy, and that guy is going to read the stuff. So thank you for doing that. But back to our chart here, let's talk about the first technique that we've already been applying for some traders who are looking for extremes, either on an individual stock or on a market, and that is the use of oscillators as lower studies. So both our RSI in our trend value momentum strategy set here, trend again refers to our moving averages, value might be what an RSI trader sees when they see the RSI at extreme lows. And MACD might tell us our momentum has hit a very extreme low and is shifting. But yeah, for some traders, to identify extremes, what they might do is turn to these oscillators. And when oscillators do something that's uncommon, that might be one definition of extreme. And one of those is it's relatively uncommon for the RSI to get down below 40. Usually requires a pretty sharp dip in price. So when we get that dip below 40 into that oversold territory, that can perk up the ears, pique the interest of some technicians out there. And you can see over the course of this last year, that's actually done a pretty fair job of identifying extreme, let's throw extremes in air quotes because that's a kind of a squishy term. It can be defined in a number of ways. This is one way that it might be defined. Our RSI getting down below 40 might indicate the extreme, but what the trader might be looking for is the start of a snap back from that extreme. You know, it's not just enough that prices have come down, because there's, of course, the threat that it may be a falling knife and they might fall further. So how do we know if prices have reached an extreme and have also started to show at least some signs of life? Well, for an RSI technician, it may be that we're rising back up above 40. So that's going to be technique number one that some technicians might use, and it is using oscillators in the lower studies below the price chart. All right. So let's just park that in our brains for now. But for right now, Netflix, it rose, started its way up. We had a stop in place right down here below that recent support just before the entry. And we're moving in that direction again, but still above that support. So we haven't hit that stop just yet. All right, but back to our final position. This was last week's trade, I believe. We have Philip Morris. Let's go to the chart there, PM. And let's load up our PM study set. And we had the Chaikin money flow that we discussed last week. And what we noticed here is that that was just starting to strengthen. It had dipped below the zero line, and we started to see an increase in our indicator. And also that coincided with a nice touch off of a recent support level. So we took a look at recent price advances, used those as a gauge of how far price might move on this advance, and set a target up there at 165 with our stop just down below those recent lows at 148.50. And guys, we actually got a decent move in the intended direction initially, but was this last week? Must have been a little bit earlier. Let me just, now that was, it was just off the evidence of this bounce. We got in maybe a little bit later. In any case, we came close. This is our second one. AON, so close to that upper band. That's the way it goes sometimes. Philip Morris, so close to our target. Didn't quite get there. We're starting to fade. Our stop is still in play. We'll see if that gets hit. We'll revisit again next week, see if we get there. But that's it for our existing positions. So overall, yeah, we're down some. I actually was anticipating the way that the markets had behaved over the last couple of days, and I follow up on these webcasts. This Friday webcast, I look at it on Fridays, and seeing what the markets had done, I expected a little bit harsher truth here than what I'm seeing right now. So we'll take that as a win. But in any case, let's go plan and place a new trade, and let's use some of the new knowledge that we've already gained. If it was a new indicator, that discussion of RSI, let's go to our charts and have a look at the S&P 500. I know this is rough, but let's come up here to our studies. I'm going to load our TVM for the S&P 500. Where'd it go? I mean, it is still. That's interesting. Do my eyes deceive me? Did I accidentally delete? Oh, there it is right there. I just didn't put, I typically include the symbol here. In this case, I just didn't. So let's load that on. There we are. So here's our TVM study set, and what we've been watching for over the course of the last several months since we had our discussion was this event right here. John says, could the market close early today if we hit those, if we hit the curbs? Maybe. But we had a crossover of our faster moving average down below the slower. And for some, that's something, it hasn't happened in a long time. So that could be a signal, wow, maybe we should ease off the throttle here a little bit with new bullish positions. And at the same time we got that crossover, we'll also notice we got a bearish downturn in our RSI. That was really right as we were transitioning from this sort of doji candle to a bearish engulfing right there. And then down on our MACD oscillator, we had the green histogram bars transition to a darker green. So this would not necessarily be considered an extreme, but for those that use MACD, the oscillator there, as a potential extreme, it might just be in the short term that was an indication that we were as high as we're going to go on the S&P 500. And since that confluence of evidence, crossover, roll on the RSI, dropping MACD, here's what's developed. Now, it's not because of the technical tools, but they were an indication that maybe there's something over the horizon. Now, that still leaves us with, this is kind of interesting. Our RSI is at its lowest level that we've seen all year. Now, that's not bullish, usually, to a would-be bull, but they might still be on a little bit of alert. Well, this is interesting. This is the furthest down we've been, and for those traders who look for snapback events, even if they're short-term, this sort of a dip might have them on alert, and if we can get that RSI to start to rise again, they may actually start looking for bullishness from the index again. Let's see. And how much are we down now? About 5% on the S&P 500? Yeah. Now, another thing, so we've learned one way that traders might look for extremes, and that's using those oscillators. Another way is to use drawing tools on the chart. So it's sort of bringing in one's own experience and one's own sort of skill to the chart. But here's another tool. I'm going to come down here and use our Fibonacci retracements tool. And one way that some traders measure extremes is to wait for an extreme to develop, a big move in one direction or the other, and then use that as a measuring device for maybe the next one. So when we got this big, uncomfortable for the bulls sell-off for the S&P 500, where we dropped about 10.5% right there, for some, they may wait for that to start to rally again, and then use that as a gauge to measure extremes. So let's use our Fibonacci. And when we're using the Fibonacci retracements tool, here's one thing that I want to point out. If you've used this before, I get questions every time I do it this way. So let's just address it right up front. I'm going to draw a Fibonacci from the bottom of this down move to the top of that down move. So my first click is going to be down here at the bottom, right there. And then I'm going to move that up to the top and click again. Okay, that's important to do it in that order. When we draw Fibonacci's in the opposite direction, like let's say here's a strong up move, so we go to the top of the move and click and move down. When we do that, the order of events for the two clicks determines where our extensions are drawn. So you'll notice here I drew a fib, and I get extension lines, potential target lines above that move. If we draw from bottom up, I get extension lines to the downside. Let me get rid of this one. It's kind of obscuring things. But you can see there's our Fibonacci extension to the downside. And this is where a trader looking for extremes, using historical extreme moves as a gauge, couple of things are interesting about this move. We had this strong run down. You Fibonacci traders, when we get a strong move in one direction or the other, and then we start to get a counter move, how far do we typically expect that counter move to carry price? So if we have a strong move down and we get a counter move up, how far might a Fibonacci trader expect price to move up? Well, generally, they may expect somewhere between 1/3 and 1/2 of the move of the original move as the counter move. So that might take us to the, let's do this. For right now, let's go up here to our studies. Actually, let's do it this way. I'm going to go to the Flask. Let's take off our RSI and our MACD. There we go. It just gives me more room to work with here, and I can see the individual lines on our Fibonacci's. Yeah, so Chris says somewhere maybe as much as the 50% retracement to as little as the 61.8. So it's quite typical to expect a rebound move to sort of peter out right in between those two levels. And look at what the S&P did. Now, once we get a resumption of the original move, how far might we move from there? Well, in this case, an initial expectation might be to get back down to the 100 level. The second might be down to the 161.8. And it's kind of interesting at this point. Have we reached, as far as a Fibonacci trader is concerned, a potential extreme? Could be. Yep. We just nicked. I mean, I couldn't really have mapped this out much better for how the markets have behaved up to this point. Now, is the fact that we're sitting right at 161.8 a guarantee that we're about to go rocketing back up to the moon and we're all going to be feeling a lot better about our retirement scenarios in a couple of weeks? That's not the case. It might be. We'll see. But a Fibonacci trader might think, well, maybe we'll at least get a bounce back up. Maybe half of this distance right here. So possibly that might set an initial return target of maybe 5,300, something like that on the S&P 500. But in any case, there's starting to be a little bit of evidence showing up here that maybe the S&P has already made an extreme move, and could we be start into a snapback move? Time's going to tell, but we have an RSI deep in oversold territory. We also have our drawing tool, our Fibonacci's lining up just how a Fibonacci trader might expect. Well, let's just say that our trader's starting to have a suspicion. You know what? When stocks are way up high, that can be associated with greater risk of just this sort of thing happening. Well, maybe the thing has happened now, and it's opened up a new window of opportunity for those that were looking for the stocks to for stocks to maybe blow off some steam first. So I want to talk about another final tool for measuring extremes, and I want to do this using an individual stock. So we need to pick a stock. Let's put ourselves in the shoes, and this is probably going to make some people uncomfortable. Now, no approach is going to be universally comfortable, but let's say we're putting ourselves in the shoes of a counter trend trader who's looking at this strong sell-off as maybe a window of opportunity for taking a new bullish trade. And they're going to leverage that. Let's say we're going to look in the most abused corners of the markets. Let's look for maybe which sectors have sold off the hardest. Which sectors? Somebody chat in, let me know. Crash says, think you've been using the Fibonacci tool backwards. It probably has been serving its purpose anyway, Crash. But yeah, if you want to get the extensions moving in the correct direction, draw it in the way that I indicated. Yep. In any case, which sector has really taken some lumps from this tariff sort of tension right now? Well, if world trade is facing some real concerns, then there's not a lot of shipping going back and forth. There may be not as much demand for oil and energy. Energy has really been, taking it on the chin. It's not to say that other sectors haven't also been getting, beaten up, just some to lesser extent, some to a greater extent. How can we see that? Well, if we come over here, let's go over to the watch list area. I'm just going to load up a public watch list that's maintained and published by Thinkorswim. And I'm going to go to the one that says sector indices. These are the 11 sectors that make up the S&P 500. And then you'll also notice that I've customized my columns here to show me which sectors we're dealing with. If you click on Customize Column and you look for description and add that to your list of column headings, this gives us the name. Because as is commonly the case, symbols don't always line up with, they don't tell you exactly what a company is or, what an index is. Like CRM, Salesforce. How would you ever get Salesforce from CRM? Anyway, pardon me. Let me mute myself. There we go. But yeah, what I noted here as I was looking through the different sectors, if I clicked on energy, look at the drop that those energy stocks has taken. Well, I want to do a little bit different analysis with this. Let's stay here with energy. And I'm going to change up my study set. And I'm going to load again. Let's actually just take these studies off. And several months ago, we had a discussion of using linear regression lines to identify extremes. Now, I don't know if you recall linear regression lines, but let's load those up on our charts. And I'm gonna switch this up even to a longer term chart to give sort of a different perspective of what the energy sector has been going through. But I'm going to go up here to my edit studies. Let's type in LINER for linear regression. And I'm going to add a couple of our channel line tools here. So let's add the 100 linear regression channel, and we're going to add the 50 linear regression channel. Click apply, click OK. And this is a combination of 3 linear regression tools. We have the linear regression line, which is essentially an effort to draw sort of an average price throughout the selected time frame. So where would we draw a line to go through the precise middle of the last 3 years of pricing on the energy sector? That's what this middle line is. And then we're just going with a 50 period channel outside of that and a 100. So, yeah, now people are saying oil is crashing. Is that accurate? Yeah, I think that's an accurate statement. Obviously, crashing itself is kind of a loaded term. Maybe one person's definition of crashing might vary from another, but yeah, getting beaten up. Look where this has positioned energy, though. We have come away from what's sort of the quote unquote norm and moved all the way down to over a full 3-year period, all the way out to what might be considered an extreme through this one technical lens. Now, again, if you don't know about linear regression lines, what you can do here is just come to our channel, and right there is a search button or search box. Just type in linear and hit enter, and you'll see right here my full discussion of combining 3 linear regression line tools into one trading strategy. But this is a third way. We've used lower studies, we've used drawing tools, and now we're just using a technical price study that's applied automatically to a chart to gauge how extreme have things gotten. All right. Well, for energy, we've reached a linear regression extreme, reaching the furthest bearish extreme that we've seen since July and October of 2022. Now, could things get worse from here? Absolutely. Yep. Risk is high, volatility is high, but interestingly, mathematically, risk is lower now than it was on February 19th, because essentially, let me just put it this way, there's not as far left to fall. Anyway, but let's say that our technician has taken note of this. They note, wow, we've come down to this linear regression low. Yes, we might also be at horizontal lows. That could be the case. I also noted that on the S&P 500. I didn't call it out, but yep, we're right down to lows that we saw earlier this year, which were at that time felt terrible, and yet from that point, dramatic recovery. Now, so let's say that the trader thinks, okay, maybe energy is at that extreme low. We could get a bounce back event. Typical bounce back, maybe just going back up to the next linear regression line. But let's have a look at an individual stock within this sort of beaten up sector. Now, if you don't know how to find individual stocks, there are a number of ways to do it. But a quick way is to just go to the Visualize page on the MarketWatch tab. If you go to Visualize, you can set it to the S&P 500, and then you can look at the individual sectors with their associated stocks. So information technology stocks are over here, consumer discretionary is up here, communication services, they move around a bit, but here are poor beaten up energy stocks right down there. And as I looked around, as we move around on this chart, we can see, okay, which ones are beaten up the worst today? And I noticed MPC. Let's go to MPC. Talking about extremes. Yeah, back in what week was this? This was the first week of April of 2024. MPC, Marathon Petroleum, had a great run of weeks, taking it pretty far away from sort of an average price through the course of the trailing time frame of the previous weeks, reached an extreme up here on April 1st, and then it's been breaking down through those linear regression lines, even came down to this 50, broke down to that, and we've now reached an extreme potential low. That's on the 100. We're now challenging an extremity equivalent to the most extreme high that we've seen over the last 3 weeks. We're now at a most extreme low. So for a trader looking to do a counter trade position with some technical evidence of extremes, this could be one way to identify it. And if we switch this to a shorter term chart, we'll see a similar thing. This is interesting. Not quite as extreme on a daily chart. And as a matter of fact, Marathon has been hovering when it gets down to the 50 linear regression. It's had a tendency to pop back up and go back to the midline, the linear regression line itself. You can see that happening over and over and over and over and over again this year. So even though it's in a downward trend, when reaching extremes, maybe our bulls have a window of opportunity. Now, time will tell whether we get that move back up. But here's going to be our final trade, our final scenario here. We've walked through 3 different ways that extremes might be measured: using oscillators, using drawing tools, and now using a price tool known as the linear regression channel. Well, here's going to be our trade. We're going to buy the stock right now on the evidence of just being at that channel. Yes, we're getting kind of a long tail. It's maybe a little bit more reassuring, kind of looking hammer-ish, but really just because we're down at about that 50 linear regression line. Now, if we continue on our way down further, that's not what our trader is looking for. So let's put in a stop down here below today's candle. We're not going to be very patient with this. Where does that put us? Maybe about 114. We'll put our stop in down there, but with a near-term target right up here. That looks like that's going to be about 130. We'll just call it 136. Okay. So buying it at 121, targeting 136, maybe a $15-ish profit potential. Stop down there at 114. That'll be about a $7 loss potential. Let's go place our trade. Am I making anybody uncomfortable? I know counter trend trades can feel, it feels tough sometimes because it can be more reassuring. Hey, when stocks are going up, isn't that when we have a lower risk, higher reward scenario? Maybe. Problem is, when stocks have been going up, there's that tendency to fail rapidly. We've seen that today and yesterday. But let's go to MPC. I'm going to right click on our ask price. Let's put in a custom buy order with an OCO bracket, 2 sell orders. We're not going to buy 100 shares. That would be a $12,000 trade. Let's cut that down so it's getting us down below our $5,000 threshold. That's going to be about, what, 40 shares? Let's link these orders together so our quantities match. And I'm going to put in a market order. Obviously, there are risks when we put in market orders. We might not be thrilled with the price we pay. It's trading right now at 121.20, but that's not a guarantee that we'll fill at that price. We're going to put in our target. That's our limit order up there at 136. And our stop we were going to put down there at 114. Make both of those good till canceled. And a couple of important reminders as we place this trade. Let's click confirm and send. So we're buying 40 shares at the market price, and there's this reminder here. With market orders, prices can change quickly in fast market conditions. And guys, we have fast market conditions right now, resulting in execution prices that can be different from the quotes displayed at order entry. Now, another thing is we have a stop order in place. We have a stop at 114, but with stop orders, there's no guarantee that the execution price, if our stop is triggered and the order fills, the price at which it fills, we're not guaranteed that it will be equal to or even near the activation price. The activation price is also sometimes known as our trigger price of 114. Now, there's no commission on this trade, but there can be on some types of trades. But let's send this order off, and we'll see how things go from here. But there's our trade. We have our target up here, our stop right there. Oh, look at that. All right, it looks even a little bit better hammerish now. Getting a little bit more recovery. We'll see if we can continue in that direction. But let's make a quick note on our studies. Let's come up here and save this study set. And this is going to be our MPC linear regression study set. So we'll save that. And guys, we have accomplished what I set out to do today with that trade in place now. I wanted to talk through our existing positions. I wanted to take a look at market conditions and discuss how, for some traders, when extreme markets manifest themselves in one way or the other, actually, an extreme move to the downside to some may be interpreted as a reduction of risk. Now, volatility is still there. This trade is very likely to be over pretty soon. We'll see if we got on the right side of things. But I also wanted to talk about these 3 different ways that traders might use charts to gauge extremes? Where are extremes? How might they be defined on a chart? All right, everybody, thanks for giving me your time today. I'm going to let you go watch the rest of our webcasts and then enjoy your weekend. But just remember, a couple of suggestions here. Number one is that if you haven't subscribed to our channel yet, do that now. You can go down below the video stream, click on the subscribe button. It literally takes a second, doesn't cost anything, but our YouTube channel is where we house these webcasts when they're not live. All right. Also, make sure that you're following Ben and me on X. You can find Ben there at Ben Watson CS. You can find me on X. Let me show that to you. This is my handle on X at Cameron May CS. Make sure you see this picture. Make sure you see that picture. But most of all, make sure it's at Cameron May CS because there can be similar names out there on social media. Got to be precise. And thanks, everybody who's already clicked the like button. That's always appreciated. We have over 200 people watching and over 50 people, 57 people have already clicked the like button. Thanks for doing that. Whenever you enjoy one of our webcasts, do your presenter a favor and click that thumbs up because it applauds the presenter's efforts. It also gives a boost to my webcast in the YouTube algorithm, helps more people find these webcasts and learn about things like gauging market extremes using technical tools. Now, a final thing, we do have that survey. Thanks, Ben, for reposting that. Really appreciate that. If you haven't done it, go click on that survey link. Give me your honest feedback. I'll read through those, the comments and the data, and it always helps. Everybody, thanks for giving me your time today. I will see you again next Friday. Or, of course, you're invited to join me in my other weekly series. I have something new every day of the week, so I'd love to see you in those other ones. I'll look for you in those webcasts. I'll also look for you on X. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.